Hello and welcome to Switzer Investing TV. I'm Peter Switzer. Thanks for joining me. On the show tonight, we have June Liu back from holidays. And I want to know what she thinks is going to happen to the stock market this year and what are the stocks that she thinks look like really good value. In particular, I wanted to talk about the tech stocks that have been really smashed. Then we'll talk to Dave Allen, the fund manager from Plato Asset Management. Dave was recently in the AFR talking about shorting tech stocks, some of the well-known tech stocks that we actually do like. I want to know why he's so anti-Aussie tech stocks, and we'll see where he thinks we can make some money in 2026. And finally, Paul Rickard's coming on the show, and he's going to look at income stocks. If you're looking to be a little bit more cautious, you either are looking at term deposits or else stocks that are good, reliable income payers. Paul's done the homework on that, and we'll see what he's dug up. So let's kick off now with June Liu of 10Cap.
Thank you for having me, Peter.
Now, I got to start off with probably one of the most important developments for our local market this week, namely the Reserve Bank meets tomorrow. Are you expecting a rate rise, first of all? And secondly, how do you think the market will react to it?
Look, I'm still of the minority that's sitting there thinking there won't be a rate rise. I think the market is pricing in 60% probability of a rate rise. So if it doesn't come, there will be a bit of boost for the market to uplift. But look, net, we will have one rate rise before, for the first 6 months of the year. So it's coming. Whether it's tomorrow, whether it's May, it's coming. I think the market has been overly pessimistic about this. Look, we know the inflation is a little bit higher, but recently the data we've seen with the inflation and the like, it's kind of just in that gray zone. It just become more sticky. And we're seeing all the sectors being sold off, more the interest rate sensitive sectors. And I think, if it doesn't come tomorrow, you'll have a bit of rally. If it comes, that's pretty much majority in the expectations.
Yeah. All right. So, so far, has the market built in the expectation of a rate rise and then as a consequence sold off stocks like JB Hi-Fi that had a fantastic, I guess, 2025. And given that, and I do know the share price has fallen quite significantly from its all-time highs, and I know you're a great fan of JB Hi-Fi. Is it a buying opportunity, JB Hi-Fi?
Yeah, I think JB Hi-Fi is a buying opportunity now. The share price has collapsed pretty much. Consumer discretionary, being interest rate sensitive, has been the second worst performer after just tech in the last couple of months, and JB Hi-Fi being the worst performer out of the discretionary. The reason being it was expensive, and now people worry about the rate rise and the like. It's been sold off. Now, I think the result will be still pretty reasonably okay. I think the trading update will be pretty strong so far, what we heard about the replacement cycle for computers and everything. Consumers okay. And I think the earnings multiples, has come down about 7 PE multiple now, in 2 months. It's incredible. For me, it's a buying opportunity. The share price might go sideways for some time, but, you really see values here.
Yeah. You might remember, and I know you do, there's a period of time where JB Hi-Fi would go from about 25, 27 to 50. And whenever it went down to 25, 27, Paul Rickard and I would say, this is a screaming buy. I guess it's just a new elevated level. So it was over 100. Now it's what, 80 something?
80, yeah.
Yeah. Yeah. It just seems, it feels as though it's the same story, just at a higher price level. And I will say personally, whenever I deal with JB Hi-Fi, even the young, weird-looking salespeople are great at sales. I actually said to one a few years ago, "No wonder your share price is so good." And she looked a bit surprised. She probably was an investor, but I said, "Your service is so good. It's no surprise that the share price was so high."
Absolutely. I really think it's because the culture, they really built that entrepreneurial culture. So everyone walks around with this little machine and then working out what price they can give it to you. That's very different from other retailers where it's a little bit slow moving. It's not so entrepreneurial. So it's really in their DNA. That's why it's such a great retailer. You really want to buy them when they come down to that level. You're right. It's about 80. The range is about 80 to 100 at the moment. Compared to a few years ago, they just grown a bit bigger. And then they have more categories. So yeah.
Okay, let's go to the next area where a lot of people are asking me questions, and that is this tech sell-off over the top? And if it is over the top, if you're a patient investor, is it time to start picking up the likes of NextDC, Zero? Probably they're two of the ones I really like. But what is your view on these companies?
Yeah, maybe on these companies, it's absolutely being oversold. Right now, the reason is just not finding support. So, in the case of NextDC, I actually think that you already seen some sort of share price support. That's the thing about, being investor. You can be very patient, but of course, you can find better price. So we call it the easier way in, right? You buy a little bit when it falls, you get to a price that you like, and then you watch the stabilization in the share price. So that means most of the sellers already gone, and then people are sort of nibbling down the bottom. That's where Next DC is at the moment. And then they're winning so many contracts. The only thing holding it back, that is not rallying away is because people are a bit worried about how they're going to fund it, because each data center costs about, I don't know, $5-6 billion, right? So they got a couple to come, and they won all the contract. Now they need to find a partner to come. So I think that announcement is coming. I don't think they're raising equity to do it. I think what they will do, they will have funding partners like Superfund and others. And that announcement is probably coming very soon. So I think Next DC looks very, very interesting. It's absolutely a buy here. Zero is a little bit. I think if you take a longer term, take a 12-month view, it absolutely will be higher from here. At this stage, I think it seems to be going lower every single day, and we just still. I think what's happening is that globally, people are worried about software, how it can be disrupted by the AI, the agentic AI, what they're going to do with the accounting software and a whole lot of other things. So there's a bit of uncertainty there. But at the price, we used to say $100 is the zero price, and now it keeps going lower. I certainly think it's a buy. If you take a 12-month view, it looks very, very reasonable valued.
Yeah. Look, I'm very impressed with what AI has helped me in my business, but if anyone believes that AI could replace the benefits of Zero, to a small business owner who's addicted to their software, I I just think this is a great buying opportunity. I could be proved wrong, but I think Zero.
I agree.
Uh,
I
uh,
agree.
but let's stay in the same area. Um, REA. Now, all the analysts like it, and once again, the people mentioning there could be an AI threat to REA. And this weekend, I put in houses to buy in Bondi just to see what happened, and REA
Yeah.
top top.
Absolutely, absolutely. REA is the number one buy at the moment. I think it's very, very defensive, and then it's got that mode. So people don't understand. They compare the classifieds business with the like our listing business with the U.S. property listing business. Now, in the U.S., all the houses listing are registered with a centralized agency for free, so it's open to anyone, right? Whereas Australia, you have to be registered with REA or Domain or others. And so it's a proprietary data. So it's not open. It's not like open, any AI can come in and use that fresh data. So we've seen it again and again. Google tried to come in, they try to do all that. It doesn't work because these guys controls the data. And in fact, REA is actually working on those AI tools. They're working with OpenAI to work on better tools for their products. So I think REA is way overplayed on the competition with CoStar. I don't know if you've seen the CoStar which bought Domain. People worry about they're going to spend so much money here in Australia to take share. They are under so much pump in the US. They have activist investor telling them to sell all assets except the US commercial business. So yeah, so it's they pulling back with spending, and then also then people worry about the AI threats, and I think it's it's overplayed. And then REH is about to deliver a pretty good result. We know the listing is a little bit soft, but they put up their prices very reasonable, and then they'll give pretty good operating leverage. It's still remains one of the highest quality company here in Australia, and now a whole lot cheaper.
Okay. So I've given you a few ideas which you've supported me on. Give me an idea. What's the one company that you've added to your portfolio or bought more of because you can just see 2026 is going to be good for this company?
Look, I think there's at the moment there's a few ideas that we just haven't previously were never in. We're looking at some of the value company. I don't normally go out there saying this buy the bad quality companies and the like. So at the moment we added more to the likes of ResMed just had a good result. It's actually a value stock now. It's pretty cheap. It's and the share price hasn't really gone up because people worry about the GLP-1 and others. And two is that there's another company which you don't normally hear me talking about is the boring company like MCore is actually looking quite interesting.
Yeah.
It's on 10 times earnings.
Yeah.
The company, look, the top line is tough. Like it's got some issues, and top line is very tough. But it just made the acquisition that it made in the last year has or consolidated last year has meant there's a lot of self help happening. They have a lot of synergy to come through, which means earnings growth will come from the synergies, and at very very low valuation. And and also it's a de-gearing story as well for the next 12 months. So now this one is a low quality business, but everything has a price. So these are the things that we're sort of looking at. That's very interesting. Aside from obviously the tech company that's sort of being sold off, the quality names. The on the quality end, of course, the Pro Medicus we always like. We think the company, the earnings is still very strong. Nothing's really changed. It's just become a whole lot cheaper. Again, that's the other expensive side of the spectrum.
Okay. One last one, and I have to ask this question because there are lots of people who are biting their fingernails, hanging off ledges, hoping and waiting for CSL to come out with a better report. Are you expecting them to report better on February 11, I think it is?
I think the result will be in line. But remember what they said is that actually it's very hard for them to really, really miss because they said it's going to be second half weighted. So that means the result, they gave themselves room to not miss. So I think the result will be in line. Potentially I heard the flu is going to do a bit better because remember, a big part of the downgrade was the flu business is doing too tough and people are not taking vaccination. But we saw recently Sanofi's result which is a competitor in that space, saying that actually vaccination rate is actually a bit better than expected in December. So I think the result will be in line to slightly better. And maybe you get a bit of relief. But remember, it's very second half weighted to this company's result.
Okay, right, yeah. I hope that provides a bit of relief for all those people panicking about CSL. Jimbo Liu, great to see you. Thanks very much for joining us.
Thank you very much. Thank you, Peter.
And now we'll catch up with Dave Allen from Plato Asset Management. And I want to know why he's so anti-Aussie tech stocks. Thanks for joining us, Dave.
Fantastic to be here.
Now, I should explain to people before we talk about your illustrious career at Plato. I always remember when you were probably 17, probably before the HSC trials, you weren't able to play football because you were injured and you were cheering on the team you captained and you were walking down the sideline with an economics textbook in your hand on a Saturday afternoon.
Is that right?
I will be a fun manager. Oh my day. Do you remember that day?
I don't remember that, but yeah, vaguely plausible. So
Oh, yeah. As a former lecturer of economics at University of New South Wales, I was very proud of you carrying out economics textbook. So explain to people watching what you do at Plato.
Yeah, sure thing. So I've been with Plato 8 years now. Before that, I was 15 years at JP Morgan Asset Management in London. Plato, for anyone who doesn't know, they're a boutique fund manager that takes a much more systematic approach to investing. So on staff, we have 4 PhDs, including myself. One of them has a PhD in astrophysics, so rocket science. I keep waiting for him to say something stupid, so I can say it's not rocket science. But he hasn't said anything stupid yet. So we try and take the emotion out of investing, collating a huge amount of data, over 850 different databases we have access to, looking for edge in markets, looking for mispricings, and that really is what underpins what we do. So it's quite different than a traditional fund manager. There's a lot more gut feel and talking to management, that sort of thing. So we've got about 25 billion under management now. I run the global long short strategies. So for any investors who don't know, we're investing in companies with a view that they'll appreciate, but we're also, when we find companies where we think they may be under pressure, they may have questionable accounts, we look to take short positions.
So you said global, that means you're local as well as international.
Exactly. So Australian markets only make up, 2% of global equity markets. So we are active here, but much more active abroad.
Okay. And the reason why I wanted to talk to you, apart from the fact that, I want to talk to you, was you featured in a story in the AFR recently where you were talking about shorting a number of tech stocks in Australia.
Yes.
All right. So a lot of people watching this program are looking at some of the great tech companies in this country. And we haven't got many, but there are a couple of really good quality ones, and their share prices are really tumbled. I can't remember precisely the ones you were shorting, but was NextDC one of those?
Yes, NextDC, correct.
Okay. Well, what's your view on NextDC?
Well, NextDC, we've some of the shorts that we have are quite tactical. They may be for a month or two.
Yeah.
But some are longer. The average short holding period for us is about 200 days. Okay. NextDC, we've actually been short for 4 years. Okay. Over that period, the stock price is down about 4%, and I think the ASX is up about almost 50% over that time period. So the reason there is several. Firstly, the type of tech company we prefer to stay away from is ones that are extremely capital intensive, and because NextDC is these big beautiful buildings, and we just like to see that that the growth is right there in front of us to see, not in revenue, but in real cash flow from operations, and that's not what we're seeing with NextDC. As a result, they've had to come back to market several times to raise fresh capital. I think they've raised probably about 2 billion in the last 12 months on a market cap of 8 billion or something like that. So the interest covers a third. So these companies, I'm not saying NextDC is a horrible company, but I think there's far better opportunities abroad. And to your point, Australia, we do have some fantastic tech companies, but if you look abroad, if you broaden the lens to obviously particularly the United States, the quality there is just so much higher. So you'd say, well, if the Australian tech names were far cheaper, then that's okay. Everything has a price.
Yeah.
But if you look at the price earnings ratio of the ASX 200 IT sector, it's over 90.
Yeah.
Okay. You compare that to the S&P IT sector, and it's about 35. Yeah. So I just struggle to see how that's justified, and that's probably why there is a bit of downward pressure there.
So what you're saying, I feel as you're saying it, because we haven't got a real lot of tech companies, when we do play tech, we overplayed the good ones we've got. And so when Zero only went to 200, it was probably because tech was massive in America and they bought Zero because it's a good quality company. But you would argue the price went too high.
That's exactly right. It's just a supply and demand thing. If you look at, I said Australia has 2% of global equities. Australians have a huge home bias in investing. We invest 40 to 50% of our equity allocation domestically, and so that's hugely disproportionate. There is an argument in the case of income stocks because we have the franking regime. It makes perfect sense. But tech companies, there's virtually no income or franking to speak of. So that desire to play tech, so therefore I'm going to play it in my backyard, isn't necessarily the best place to do it off.
Is there a tech company locally that you think doesn't fit the bill of being overinvested in, and its price looks reasonably attractive.
Yes, and I guess, depending specifically how we're gonna define, tech, but, Hub24, is a heavy tech focus, and, yeah, that's a name that we like here, domestically. So we're certainly not against all Australian stocks,
That's
at all.
good. As a Kiwi, mate, it's unusual for you to pick on Aussies.
Indeed, indeed it is.
What about a company like REA? It has been sold off lately. A lot of people say could have an AI threat, that
Yes.
sort of stuff. Have you run your eye over REA?
Yeah, so we're not long or short, but I'm sympathetic to the argument. If you look at the breakdown of the technology space in the US, it's 60% semiconductors and technology hardware. In Australia, it's 70% software. Okay, and that sort of space that is far more vulnerable to disruption through AI. And I'll give you just a quick story to demonstrate that. It used to be the case that the moats for companies like this, and software companies in general, was certainly it was their code base.
Yeah.
Okay, that takes years and years.
The wide moat. Oh, competitive advantage. All that stuff.
100%. And I myself spent 15 years coding, and now we can have graduates come in that have never coded at university, and within 6 months they're writing code of a higher standard than my code. It's incredibly disappointing. But that's the way of the world, and what it means is that the value chain could face quite a bit of erosion in some of these names.
Let's talk about the big picture for 2026.
Yeah.
The feature story in the AFR talks about you shorting, but you ain't short. You're a long and a short.
Correct. Yes.
So obviously there is no science for working out Donald Trump, but he's a very important variable, isn't he? Nowadays?
Yes. Yeah.
Much more than we would have ever expected.
Mm.
So what have you done to understand Donald Trump?
Yeah, no, that's a great question. We spend, because so many of the consensus narratives, particularly relating to Trump, have been upended. And I'll give you a few examples. If you look at, let's just look at the last 12 months, for example. Yeah, Trump in the White House, consensus narrative, drill, baby, drill, light regulation on oil. That's got to be a great place to invest in 2025 in his first year. It wasn't green energy names actually outperformed oil. Okay. If you let's look at the crypto space. Crypto is supposed to be ultra light regulation through Trump, going to make US the cryptocurrency superpower, all this hyperbole. That didn't work out either. Like if you look at Bitcoin, that was down 18% last year and has had further to fall. So I think a lot of the easy, almost lazy narratives can get you unstuck. So how do we actually look to attack that? And I'm very much of the view that it's very hard to manage a risk that you can't measure. Okay, so how do you measure someone as mercurial as Mr. Trump?
Yeah.
And we spend about a third of our time on the risk management piece. It's not the sexy side of masking 10-bagger stocks, but it's so important. You can have great stock selection, but if you don't marry that up with excellent risk management, you can get into trouble. So how do we look to do that? Well, we have over 100 different stress tests that we run our portfolios through every single day, much like a bank will stress test their loan books.
Yeah.
Okay. And so how do we actually go about that? If you're stress testing your portfolio against something like the oil price, that's pretty straightforward. But if it's something like, is Taiwan going to be invaded by China, or is Trump going to lose control in the midterms, or is Trump going to acquire Greenland? They're very difficult, thorny issues to get your hands around. So the way that we actually do it, let's look at what we did last November, coming into the election, or November 2024. Sorry, the academic evidence tells you that the single best predictor of election outcomes, it's not the pundits on TV, other than yourself, of course. It's not the polls, but it's the betting markets.
Yeah.
Okay, and so coming into the election year before last, we will use various betting markets, which give you a daily odds, which we convert to a daily implied probability. And we regress those daily changes. So find the correlation between those daily changes in probability against about 20,000 stocks globally. Okay. That allows us to see which stocks are most sensitive to different outcomes.
Yep.
Okay. And then we aggregate that up to the portfolio level to see how we're placed. And we're doing exactly the same thing now with these other, very serious geopolitical risks, Iran being a big one, and making sure that, because everyone, it makes for fantastic dinner table conversation. What's Trump going to do in Iran? What's going to happen with Venezuela? But these things, they might make for good conversation, but they don't make you more money because they're so hard to get consistently right, especially with someone as unusual as
Yes.
Mr. Trump.
Yeah.
So our approach is measure the risks and then manage them. Make sure whatever outcome happens, okay, it's not going to really affect us unduly either way.
Okay. Clearly, people listening to realize that you're not spinning the bottle, working out whether you should or shouldn't invest generally. But is there a view on 2026 for the stock market generally from you guys?
Yes. So if you look at we track the valuation of the US market using data that goes back to 1880. And I'm sure you're very familiar, and your listeners probably are too, with the Schiller PE, Nobel laureate, and it's seen as probably the most consistent and reliable valuation metric for markets.
Yeah.
And if you look at that since 1880, the current valuation of the S&P 500, for example, is at 38.5, which places it in the very top 3 percentiles.
Yep.
So if anyone tells you that the US market is not expensive, you should politely excuse yourself from the conversation and walk the other way. Things in the market are very
Why do you
expensive.
politely, man? We're going.
So I would caution just long only index exposure to markets for that reason, that are very indiscriminate. Because one thing that's also at a record level is the dispersion in valuations between your really expensive names and your really cheap names.
Yeah.
So think for
The Magnificent Seven has created this very unusual situation where the index has been flipped up.
Exactly.
But if you took them out, the index is not that high.
Well, that's right.
Yeah.
That's right. So you look at a name like Tesla. Okay, their price earnings ratio is 200. Okay, not bad for what is essentially a car company with 80% of their revenue coming from cars. Future might be different, but who knows? You compare that to BMW, a storied Bavarian automaker trading at a P of 8.5.
Yeah.
Okay, so there's dispersion. And with dispersion comes opportunities. The dispersion, last time it was this large, was when the tech bubble burst, and you had the best 3 or 4 year period for value investing since the Great Depression.
Yeah.
So I think there's a lot of opportunities, but you need to discriminate. And I think for active management, which has struggled at different points, for good managers, they should shine now.
All right. So are you saying then that if someone was taking simply an ETF for the S&P 500, hedged for a rising Aussie dollar, they could be disappointed because the Magnificent Seven might become Magnificent Duds over the next 12 months or so?
Yeah, I certainly wouldn't invest my funds or my family's funds in that way. I think valuation is not a brilliant timing tool over 1 year horizons. Okay, we know that. But if you're adopting a buy and hold strategy for, say, the next 3 or 5 years, starting valuation actually is quite a good predictor of what your returns will be over that period. So yeah, I would caution about just that blind exposure that's going to inherently mathematically upweight the names that are the most overvalued.
Because what you're basically saying is that if the Magnificent Seven had been ridiculously overbought, and because they're so big in the S&P, even if they fell, say, 10 or 15%, which is not a big fall,
No.
it would have a big impact on the overall index, wouldn't it?
Exactly. It's like CBA,
Yeah,
falling,
exactly.
it's the same sort of dynamic that they're seeing there, but almost on steroids, I guess.
Yeah. Okay. Is there anything else I should know about the future, Dave, that my listeners, my viewers would like to hear?
My general approach is to refrain from making forecasts until after the events happen.
Oh, very clever, mate.
Yeah,
Very
yeah,
clever.
indeed. One of the things that like we've made half of the alpha on the fund through shorts.
Mm.
Okay, and the alpha's been material. We've outperformed the market by 13% a year over the last 4 years since we launched the fund. The number of red flags we're seeing on the short side is really elevated. Okay, there's funds, there's stocks that are under a lot of strain, and the red flags that we systematically monitor are really piling up, and there are a number of those in Australia.
Well, the one last question I think a lot of people would like me to ask is, what's your view on gold? Because if you talk about Magnificent Seven being overbought, it looks like gold is substantially overbought, and I'm friends with the people who own ABC Bullion. They're very happy.
I'm sure
They're happy about that.
I'm sure they
So,
are.
what's your view of where gold's going to go?
Well, gold in the short term, a lot will depend on those geopolitical events that we
Yeah.
mentioned. So if Iran really kicks off, gold may easily have a huge leg up. But people say, it's gold's really overvalued, but look, it's come back a long way, but it's only retraced to where it was not so long ago.
Yeah.
So for me, gold is, we don't invest just in gold, but we will invest in some gold companies, particularly the picks and shovels gold companies, where the valuations are actually not so demanding. That's where we like to be.
Okay. Dave, thanks for joining us.
Thanks, Pete.
And that was Dave Allen of Plato Asset Management. And now Paul Rickard joins me to talk about some income stocks he thinks looks like reasonably good value. Thanks for joining us, Paul.
Thanks, Peter.
Okay, let's talk about a few things. January, we actually outperformed the US market, up 1.8%, and now up about 0.5, isn't it?
Yeah, we did outperform. In fact, I think January is one of the most remarkable months I can recall in the Australian marketplace. It's just so divergent in terms of sectors and stocks going up and sectors and stocks getting absolutely slammed.
Yeah.
So I've never seen quite that in a month where it went at different ends. It just went so much change. So
But the directions we kind of predicted, we were pro-resources and we were anti-banks and the top 20 stocks that had done ridiculously well, like JB Hi-Fi and CBA.
yeah, so we had energy, which of course is oil, up by over 10%.
Yeah.
We had materials, which includes everything from BHP and Fortescue and all the lithium and
Yeah.
gold companies, a few others, companies like Amcor.
Copper and
Yep, that was up almost 10%, 9.5%. So they were the huge winners. Most of the sectors were relatively unchanged.
Yeah.
And the big loser was information technology, down 10%. So we had a lot of companies getting smacked there. Companies like of Zero and Technology One and all those sorts
Yeah.
of companies got really hit. So it was a very, very strange month. The market up 1.8%. And really no correlation with what's going on in Australia to the US, because we outperformed for a change. And again, the US is not about materials. Here it's about materials.
Yeah.
And some massive increases in some of the share prices.
Yeah. It's interesting, Paul, if the banks have actually had their sell-off, and the other three, apart from CBA, have actually been sneaking up, haven't they?
Yeah, that's right. In January, CBA down about 4 or 5%, and the other three banks went up about 1% each.
Yeah.
So it's sort of, I guess, as well as sort of money going into resources, you had money coming out of the CBA going into the other banks.
Yeah. And I must admit, I'm starting where X20 was a good performer last year. I'm starting to take people out of X20 and go back into VAS because I think the fall in the CBA is going to be fairly limited now. I can't see it falling as much as the analysts are predicting.
Yeah, look, I think it's going to take a long time to get back. I mean,
I know it won't get back,
and
it's
it's
just it's going forward.
they'll have to do a lot of really bad things.
Yeah.
So, and it'll be a very bearish market.
Because if it doesn't fall, it doesn't hurt the index,
Yeah,
does it?
but you sort of see in the way it's trading today, it's the first stock they buy today, and it's sort of like their resources are sort of having a breathing down because of what happened partly what happened in the US and the price of gold and silver, but a few other things. And the first stock they're buying today is sort of CBA.
Yeah. When in doubt, buy CBA.
So it's sort of it's a safety stock for a lot of the big funds,
Yeah.
and they're happy to park it there. They know it has deep support whenever it gets sold off. But,
Yeah.
you know, in terms of if the market goes up 10%, will CBA be the stock to take them up 10%? That's not what they're buying.
Okay, let's talk about income. You mentioned CBA. A lot of people are thinking, well, this could be a tricky year. Why don't I just go into stocks that might get some growth, but will have income? What have you come up with?
Well, first of all, I think the most important thing to realize is that market income is down.
You keep saying it's
I want to say that to reiterate that you know 3 or 4 years ago we used to think getting 4.5%, 5% income in the share market wasn't too hard,
easy.
easy. This year you'll be lucky to get 3.5%, right? So, and there are two reasons why income is down. One is because the prices of everything have gone up. So our market is now 800. A few years ago was in the sevens and below that.
Yeah.
We were down in the fours, I think, briefly in the crash for COVID.
Yeah.
So it's had a big increase. So, and secondly, earnings really haven't grown much. And what has supported earnings, particularly dividend income in the last 2 or 3 years, has been your mining companies. Now, your mining companies, although we're now seeing a lot of money go back into those sort of stocks,
Yeah.
prices haven't gone up yet.
No.
Not in terms of the big base materials. So, BHP's dividend, for example, there was a period there a couple of years ago when you were getting 6%.
It was
Right.
11% one year.
Well, I think you might have been averaging over a couple of halves. This year, the forecast of BHP is down to 3.7%. The forecast in Rio is down to 4%. And even Fortescue, which was in the double digits, it's somewhere around about 4 to 5. So those companies were very supportive of driving some of the dividend yields we got. We had a lot of special dividends being paid as well because of some government tax changes. They've gone. Get used to it. 3.5% is about the market.
We always used to say you never buy mining companies for dividends, but for a few years we were wrong. Happily we were wrong.
Yeah. So let's have a look at where you can. Let's just go through a couple of the numbers. So banks by and large now are below 4. ANZ is probably the highest. It's 4.5%. But
If you had franking credit,
ANZ is only 70% franked. So
Okay.
just be wary of that one.
yeah, good point.
The other majors, even Westpac, are now touching below 4%. Telstra, still a bit of value in Telstra, 4.1%. That's 100% franked. A company like Medibank Private, pretty stable insurance company, 4.1%, 100% franked. If you want to go for the sort of some of the real yields, you probably got to look at the unfranked part of the market. So companies like APA, it's about 6.4%. I remember when that was over 8% for a while.
Yeah.
Here's a couple to look after. Here's 3 companies over 5% paying fully franked dividends, but they've all got different attendant risks. So that's the trouble when you get sort of usually, high yields can be associated with higher risk. So
Okay.
first one is Metcash, about 5.4%. So Metcash is the big sort of
Fully franked.
fully franked. It's a big shopping
It's IGA.
IGA, plus also
Richie's in Victoria.
yeah, the IGA division is pretty strong. It has a food distribution business, a wholesale distribution
Just
business,
hardware as well.
and it's still got hardware. That's the
Mitre
50 length, Mitre 10.
Yeah.
They're not going so well. They're still struggling a bit
Bunnings knocks everyone
against Bunnings. So Metcash has won 5.4%.
Yep.
The second company is Horizon, and that's the old Queensland National Rail. It now
An
owns
exciting company.
Yeah,
I'm
so-
surprised that you've gone for that.
it now owns pretty well all both the rail track and most of the above ground trains and so forth that haul all the coal in Queensland. Plus, it's expanded into WA. It's about 5.4% fully franked. But my warning on Horizon, a lot of investors have bought Horizon at higher prices and seen the share price do absolutely nothing.
Yeah.
In fact, over the course of the last 3 or 4 years, it's probably gone down a touch.
Does it suffer because coal's on the outer pull?
It suffers a little bit from coal. It's also very regulated, so it's all the prices it can charge are set effectively by a government regulator. So it's subject to regulated pricing, and it's because very vulnerable then just to volumes. And of course, particularly coal volume, is very much responded to the coal price because a lot of people won't invest in it now. Those that do own the coal fields are sort of a little more. How should I say, a little more sort of predisposed to increase production when the prices are good and so forth. The third company, Pete, is Datura Royalties. Now, Datura Royalties gets about 90.
Ticket code.
BR. So
DR.
DRR,
Yeah, okay.
DRR. It's about 5.1%, 100% franked. It gets almost 98% of its income from a royalty from BHP. So it owns what is called Mining Area C, which is one of the big iron ore deposits in the Pilbara.
Yeah.
And BHP pays it a royalty for every
So it
ton.
does nothing. It just owns the land.
Does nothing, just owns the royalty.
It's not a lazy company.
It actually gets royalty component consists of two parts. It gets a base amount plus it gets effectively a share of the upside.
Yeah.
So if the iron ore price sinks, the royalty payment also comes down too. So the risk there is you really like investing in iron ore for that payment. So 5.1%.
Well, what's the closest done, Paul, in your memory?
Look, well, iron ore has been incredibly stable. We've seen it sitting at about $100 now for a number of months.
Yeah.
No sign of it wanting to sort of fall away. Victoria Royalty's only been a listed company for about 3 years, but generally, it's had bigger dividends. It's been trading in a range of about between, I just can't remember the big figure, it's 4 or 3, but it's about $4 to $5 or $3 to $4. I just can't remember the big figure. It's okay. I own some.
Yeah.
But so I keep it as part of my income portfolio. I'm not going to get rich out of it, Pete, because if all I'm going to get is a bigger royalty, bigger income stream if the price of iron ore goes up.
Okay. Well, I guess you don't need to be made rich. You already are rich. So
We always need to be. Our riches need to be renewed. That's what we do as investors. Right?
Okay. Paul Rickard of the Switzer Report. Thanks for joining us.
Thanks, Peter.
And that's Paul Rickard of the Switzer Report. And that's the show for tonight. Thanks for joining us. Always remember you can get a daily catch up for what we're thinking on Switzer Daily. That's switzer.com.au. And if you want real assistance with your portfolio and your investing, you should think about becoming a subscriber to the Switzer Report. Go to switzerreport.com.au. Thanks for joining us. I'll see you next week.